Sure. Good afternoon, everyone. I welcome you all to today's webinar on Road to Financial Freedom and be free of all the worries in your life. So let me begin by introducing myself. I am Vanshika Patni and I'm the Jaipur City representative for Together Investing Club and A3D Capital. And today I have along with me Mr. Deven Sharma, who is a research analyst at A3D Capital, and Mr. Aditya Jaisawal, who is a financial advisor at A3D Capital. Would you both like to give your introduction?
Sure. So good afternoon, everyone. Welcome to Road to Financial Freedom Seminar. I am Deven Sharma. I worked as a research analyst in A3D Capitals, and I look after equity research for Together Investing Club and the company itself. And I've done my graduation from Amity University, Noida. And over to you, Aditya.
Good afternoon, members. Welcome to Road to Financial Freedom. And myself, Aditya, and I am financial advisor for A3D Capital. And I mostly generally advise people how to manage their financials in the market and manage client relationship for the A3D Capital. I have done my graduation from Delhi University, and I'm also a certified financial planner. And I also have worked with Birla and SDFC AMCs. Thank you.
Okay. Now I see that a lot of people have joined. So without wasting any more time, let's start with the webinar. So I would like to begin this webinar by asking a very simple question. What, according to you, is financial freedom? Anybody who would like to answer this question? No one here is willing to answer this question?
May I?
Yeah, sure.
Financial freedom is having enough income to cover our living expenses.
Okay. Anybody else? Okay, so let me just give you the basic definition of financial freedom. Financial freedom is the status of achieving enough money so that you can sustain yourself for the rest of your life after retirement without any formal source of income. Let me give you an example for this. For example, I work till the age of 55 and I take a retirement at 55. Now my average life expectancy is 75. So for those 20 years between 55 to 75, I need to sustain myself. I need to cover my living expenses. How am I going to cover that? So at 55, till then, I should have accumulated enough wealth for myself that I'll be able to live without any financial burden for those 20 years. Now, since we have understood the basic definition of what financial freedom is, so let's move forward with today's agenda. Today, we three are going to take you towards the journey of financial independence by covering the following topics. That is, budgeting and managing personal finance, which will be discussed by Mr. Deven Sharma. Different types of investment avenues will be covered by Aditya Jaisawal, and the power of time will be covered by myself. Over to you, Deven.
So thank you, Vanshika, for explaining the meaning of financial freedom, and I'll be taking it from here. So, okay. Yeah. So now that we know what financial freedom is, I'll be talking about how to attain that in the long run. So we are not talking about financial freedom in next 6 months or 1 year or in 10 years. It's a long journey. We'll be talking about 40 years. So we need a roadmap. We need to stick by it. We need a discipline in life, and we need a blueprint. So when we talk about personal finance, it all starts from income. That is the root. It all starts from income because it defines our capacity to spend, our need to plan. Because पैसा नहीं है, खर्च क्या करोगे, plan क्या करोगे. So it's the root, income. So whenever we have an income, the first thing that bites our income is taxes. So taxes is something which cannot be avoided and which should not be avoided, because government needs certain amount to run the nation as well. So this looks a bit complicated right now. It's all color coded. There are so many arrows, so many boxes, but I'll be defining each one of them. So all the color coding have hidden meaning behind it. So if we talk about green arrow is something which is not forced. It is encouraged. We should all do it. And purple arrow signifies that this is something which we cannot avoid no matter what. And red arrow signifies that this is something we should not absolutely do, or we should stay away from it. So when we talk about taxes, we can do two things. For taxes, we can either plan it or we can just give it directly to the government without planning it. So whenever we are talking about planning our taxes, we have certain deductions like ATC, ATCCD, section 24, under which we can have a deduction of rupee up to rupees 2 lakh rupees. And if we have that deduction, it goes into our investment basket. So the objective of attaining financial freedom, or the way to attaining financial freedom, is that we need to fill this bucket of investments. And if we are not planning our taxes, we will have to give it directly to the government, and that would be our expense. So expense can be categorized into three broad categories. One is fixed, one is event, one is variable. So these are the three major expenses that we all incur in our daily lives. And for most of the people, personal financial planning ends over here. They have an income, they pay their taxes, and they have their expenses, and they think कि हमने तो personal financial planning कर ली, इससे ज़्यादा कुछ कर नहीं सकते हैं. इससे ज़्यादा maybe there's not that level of financial literacy is absent or something, but the thing is that they don't want to attain it. It ends over here. And to add cherry on the top, they take a loan. It can be a loan for property or car, or even micro loans. So we are not taking loan from the bank, and it is a negative cash flow. We are taking a loan from our future self, because if bank is giving you rupees 100, and if you take a loan for 5 years, so you will have to add certain value to that 100 rupees, because bank wouldn't be like ठीक है 100 रुपए ले लो 5 साल बाद 100 रुपए ही दे देना. आपको उसमें वैल्यू ऐड करनी पड़ेगी, and वो आपकी पॉकेट से जाएगी. So that's a liability. And when we talk about this green area, this is where it makes a difference. This is the wealth maximization bubble. And whenever we are doing investment, we have certain interest that we get, or when we invest in equity, we get dividend, and that's our returns, which gets added to our income. So this is highly encouraged. And when we talk about investments, so investments can be categorized into wealth generation. And when we talk about wealth generation, that can be your in business or bonds. You can invest in these categories. When we talk about wealth accumulation, you can invest in RD, debt mutual funds, wealth maximization, secondary equity, private equity, and equity mutual funds. So when we talk about wealth erosion, so many people consider it as an investment. We get up in the morning, we just open a laptop, and we enter into trading activities. And that is not investment. That the purpose of that for many people is the adrenaline rush they get. So that cannot be investment, because in the long run it is eating your wealth away. So that can be categorized into expense, because I know a lot of people who engage in gambling activities, who go to casinos every year for the adrenaline rush. The purpose is not wealth maximization. The purpose is to have that secretion of dopamine in your brain just to feel good. And so in that situation, it can be categorized into expense, but that is not absolutely, there's no question asked that it cannot be categorized under investment. So this is the roadmap that we'll be sharing with you after the seminar, and this is something you can follow. And understanding this roadmap is not the only thing. The other part, the more difficult part, is that you will have to stick by it. The discipline. The discipline defines कि आपको financial freedom कब मिलेगी और मिलेगी भी या नहीं मिलेगी. That's discipline. It's up to the discipline आप कितना follow कर पाते हो, because it's a long journey. It's a 40 years journey. So now that we have a rough idea about how to go about it, how to plan our finances, I'll be telling you about the budgeting, what you should do when you have an income. So this is the Excel that we have prepared, and we'll be sharing this with you as well after the seminar. So what you have to do is you just have to enter the figures, and it's all dynamic. It will auto update itself. So when we talk about, just a second. Okay. Yeah. So like I'll just take a short example, like whenever you have 100 rupees. So what you have to do is you have to create 4 baskets. So the 4 basket would be tax planning, investing, expenditure, and emergency fund. So you have to allocate the fund equally. So if you have 100 rupees, so if you have 100 rupees, what you have to do is you have to allocate 30 rupees to your tax planning basket, 30 rupees to your investment, 30 rupees to your expenditure, and 10 rupees to your emergency fund. And so the whole action is going over here. So the whole action is going over here. We'll be sharing this model with you. And this is the dashboard we have created just to keep things simple. So if you have a monthly salary of 1 lakh rupees, I'll just enter 1 lakh over here. So the Excel updates itself. So when we talk and like I discussed in the past, that you can have a deduction of rupee up to rupees 2 lakh rupees, and this is the cumulative figure. Like April may 1 lakh, and after 1 year you'll be having 12 lakh rupees in your pocket. So this is how we should allocate these 12 lakh rupees of ours. And like I discussed in the mind map, you can have a deduction of up to rupees 2 lakh. So if I just enter 2 lakh over here, so the Excel auto updates, and when we go, this is the future value of after 5 years. So when we talk about after 40 years, you'll be having a corpus of rupees 15 CR. And agar aapne ye planning nahi kari hoti, it would have directly gone to the government. But after 40 years, you are having a 15 crore CR. And it's not like you are taking this money from the government. It's just that you are being smart with your money. So this is not easy money, this is smart money. And so when we talk about where we should invest these 2 lakh rupees, it can be invested at the interest rate of 12% under ELSS fund. So that's the average return that we can expect from ELSS fund or ULIPs. And when we talk about investment, so getting 12% of getting 12% of interest on your investment is not that difficult. And when we invest 3 lakh 60,000, and after having 12% of returns every year, we can expect a corpus of rupees 27 CR after 40 years. And expenditure. So expenditure is you will have to manage your expenditures in under 3 lakh 60,000 every year. And many people would be thinking कि यार मेरा एक साल का package 12 lakh रुपए, and you are saying कि I should just maintain my standard of living or live my life just on 3 lakh 60,000 every year. And ये तो हो नहीं सकता है, बहुत difficult है. एंड आपका मॉडल है ये बिल्कुल ठीक नहीं है, बिकॉज 3,60,000 पूरे साल नहीं हो पाएगा. बट द थिंग इज दैट इज वेयर द क्वेश्चन just arises, okay, do you really want a transformation, or do you just want to live comfortably in the present? Do you want to plan for the future, or do you just want a comfortable life in the present? So this is non-negotiable. This model is something which you will have to strictly abide by. And if you think 3,60,000 में मेरा नहीं हो सकता है, I would say कि ये 12 lakh वाला column बढ़ाओ. I would say generate new stream of income. I would say increase the income. But the thing is that you should allocate 30%, only 30% to your expenditure in order to have a financial security in the long run. So when we talk about the emergency fund, so emergency fund is basically abhi pandemic ka time hai, we have all realized the value of emergency fund because there are salary cuts, businesses not at that level, we are not having that much of sales, and up to some degree we are digging on our savings, and we are just realizing कि यार saving पहले कर ली होती तो अभी tension नहीं होती, because pandemic है and we never expected this to happen. And this is where your savings come by, and you should allocate 10,000 rupees. If you're having an income, monthly income of 1 lakh rupees, you should always allocate 10% to your emergency fund, and this keeps on accumulating. Like in August, आपके पास कोई emergency नहीं आई है, and you have a corpus of 50,000 rupees, and you would be thinking कि 50,000 रुपीज ऐसे ही पड़े, चलो इसमें वेकेशन ले लेते हैं, या फिर इसके लिए कोई चलो फ्लाइट बुक करके, या let's just have a leisure time. But that's where discipline counts. So we are not talking about 1 year of emergency. We are not planning for 10 years of emergency. We are planning for 40 years of emergency. And if we plan well, you can expect a corpus of 1.8 CR. And in my opinion, that is more than sufficient, or that is sufficient to cover most of the emergency you might incur in the time of 40 years. So we are just being smart with our money. We are just planning for the future. We are not living just in the present. We are also planning for the future, and that can give us the financial security in the long run. So now we will, and obviously we will be sharing this model with you after the seminar. So you can just enter all the figures you want. You can play with this Excel as per your desire, and you can plan your finances for the long run. And when we talk about investment, so we need to know where should we invest. What are the pros and cons of every investment avenue, and that would be taken by Aditya Jaisawal. So he would be briefing you about all the investment opportunities that are available in the market. Over to you, Aditya.
Thank you, Deven. So today we're going to cover about different types of investment avenues. So first we talk about what our investment avenues are. So investment avenues are those avenues in which there are different alternatives in the market. So let's suppose for equity you have gold. For gold, you have property. So these are the different avenues you can diversify your portfolio in. So first we talk about the major 5 different avenues which are present in the market. First of the avenues is equity. So in equity, you can directly invest in the stock market, which we call direct equity. Second is equity oriented mutual funds and national pension scheme and equity ULIP. These are the major 5 schemes in which you can invest in. So they are the long-term investment basically, and they give the more return than an inflation rate. And second, we talk about the fixed income, fixed deposits and bonds. Fixed deposit, which you can buy from banks, and bonds, which also a mutual fund part and equity part as well. And the safer bonds are AAA rated in the market, and PPF is the third one. And these are the all which give you around return of around inflation rate, which is 6 or 7% only. And then the third is liquid funds and saving account balance. This is the third. We generally say cash and cash equivalent. And fourth one is real estate, and fifth one is commodities. So in real estate, we have 3 different options. First is residential space, commercial space, and land. And commodity, gold, silver, and crude oil, uh, or any art paintings that are also count as commodity. So why we want to invest in different avenues? Because if we divide our portfolio into 5 different avenues or 4 different avenues, we can uh, have a less risk portfolio in the market comparison to sticking to a single thing. Let's take it to a small chart example with it. Uh, so when we talk about, if I want to represent fixed deposit on a chart, so this straight line can easily represent fixed deposit, which is a straight line, and a fixed deposit give you around 7% return in the market. So this is the fixed deposit return. And when we talk about how economic look like on the chart, so over to next slide. Yeah. So this is the economic cycle example. You can see there is a sometimes there is a depression and recovery in the market. You can currently see how the Indian economy is. So when we talk about what we do when there is a kind of situation of slump in the market or recovery in the market. So first, what you can do is over to next slide, please. So what you can do is, when let's suppose you're standing at this time, let's take a normal live example. We are standing in the February 2020, and there is a fear in the market that the virus will spread all over world or spread in India very fast. So, and there is a fear in the market, so people are thinking that the market will collapse or market will fall. So what you can do is you can simply shift your portfolio to bonds and FD. So if the market, because after March the market is fall by 35% in the market, and if you shifted your 1 lakh rupees to the fixed deposit, you will still getting 8% return. Or either you can invest it into gold, you will getting 18 to 20% from that point of view. And when over to next slide. When you have invested, so you can see that this straight line is representing your fund, which is straight line 8% profit, and the market is still at a depression shade, which is near at a red line. And when at this month the stock market is recovering day by day, so there is a recovery period. And what you can do, you can shift your entire bond portfolio to equity portfolio, and you can get a return of equity. So now your portfolio is represented by this green line. So the market is recovering, and you will get this equity return also. So that's how you can shift, or you can divide your portfolio into different avenues, and you can beat the market return. Because in market, from March to today, the market is fall by 35% and recover by 25%. And that can't be happen to your portfolio because you divided your portfolio into different. So you are in gold, you are in real estate, and you are in FD. So you are getting every return in the market, irrespective the market is going down or market is going up. So let's take a conclusion of different avenues. So if we talk about, always we talk about equity. So in equity, we always look up for a long-term portfolio. As Deven told, we are talking about 40 years. So yeah, there is volatility in the market. If you think that equity, safer return in equity will be given less than in 3 years, you are wrong. Because if you are thinking about investment in equity, you should think about more than 3 years, more than 5 years of portfolio. And second, if you talk about fixed income, so there are the shorter goal, which is less than 2 years. So there is a golden rule in the market, which is age divided by age minus 100. So let's suppose a person have an age of 25. So 100 minus 25. So he should divide 75% of his portfolio into equity and 25% of the portfolio into debt. That's how he can divide its portfolio into equity and fixed income. As Deven told in the budget, we should dedicate about 30% of the income in equity and fixed income. That's how you can create wealth for the future. And when we talk about the 10% of emergency fund, for the current month, you can just shift it to the saving account balance. And apart from that, if you are not using your emergency fund, you can shift it to the liquid fund and get a 6.7% return, which is more than a saving account balance, because majorly banks are giving 3 or 2.7% return. SBI is giving 2.7 and HDFC is giving 3% around. So better than, if you are not using an emergency fund, you can get a nearby about percentage in liquid fund also. Then we talk about the real estate. Yeah, real estate is a long-term investment. Yeah, it's good. We can take this, but the problem with the real estate is the liquidity problem. I can't sell anytime in the market. And second thing, it requires huge amount in the market, which is not possible for a initial who started earning. So what he can do, he can just create his lump sum in equity and fixed income, and when he get a good lump sum, he can shift his portfolio to the real estate. He can do that, and he can increase his down payment, so the future liability will be decreased, and he can just repay his loan less than 4 years or less than 3 years. Because if we are taking loan more than 8 years, we are end up paying bank 3 times the money, and which is bad. Which is no one is because the people are taking 20 years, 30 years loan in the market, which is bad. And fifth, we talk about commodity. So commodity is for a shorter time, because yeah, gold give returns. In last 3 months, the return of the gold is 18 to 22%. But this is for a shorter time. If we invest in a gold for a longer term, it will give you around percentage of 6 to 7% average. And that's how the people getting difficulty in selling their stake at the time of this scarcity or this fear in the market. Because traditionally in India, the people are following a single set of investment. So my father, he is only investing in property. And I ask him many times that shift your portfolio to or divide their portfolio, because now if he wanted to sell his property or wanted to invest in something, he can't, because the liquidity problem is there in the market. So that's all for today. And I am passing next topic to Vanshika. Thank you.
Thank you, Aditya, for explaining us the different types of avenues really well. And I think we all have understood the different options available for us to invest our money. But now, I think you guys must be thinking that it is very important, that money is very important while investing. And you must be thinking that the different sources are important. But trust me, the most important thing while investing is time. Time is really important while investing, and it is very important. It is very important to see for what time you are investing your amount. So let me introduce you to this amazing, very amazing website, which is sipcalculator.in. Guys, you're going to love this website. It's amazing. It's a free website, so you can just go home and check this website out. Now, let me tell you what this website does. So here in the monthly investment column, you put in the amount which you want to invest each month. And then here in the investment period, where there is written number of years, so you put in the number of years you want to invest your money with, like for example 5, 10, 15, 20, whatever time period you want to invest your money. Now in the expected annual returns, here you put in the rate of interest at which you are investing your money. So it might be 10, it might be 12, it might be 15, whatever rate of interest you are investing your money at. So here then we click on the calculate button. After we click the calculate button, it shows us the number, it shows us the amount which we will get after investing that certain amount for a certain period of time for a certain return. So let's understand this using one example. Okay. Now, I think most of us here are in our 20s. And so we say that, okay, we can't invest much because we don't earn much. But I'm sure we all can invest rupees 5,000 a month. I don't think so. It's really difficult to invest 5,000 rupees a month. So let's put in the amount as 5,000. And here in the investment period, since we are all in our 20s, And I think we'll take the retirement at around 60 to 65. So we have approximately what, 40 years. And let me tell you one thing, that according to one of the Harvard studies, it has been said that for an average, a person works for 40 years in their lifetime. So I think we all can invest for 40 years. So let's put in the number as 40. And now here is the expected annual return. Now, again, a thing that when you invest for more than 10 years, this economy gives you an average of 12% for a year. So yes, you can put in 12% as the rate of interest, and it is really less. So 12% is something which you will definitely get. So we will now click this calculate button and see what results it gives us. Here, just see this, guys. Just by investing 24 lakhs, we are getting an amount of 6 crores. We are getting an amount of 6 crores just by investing 24 lakhs. Isn't this amazing? And we are getting a wealth gain of 5.7 crores. We don't have to work hard for it. We just have to invest 5,000 rupees per month for 40 years. That is on also at 12% per interest. Now I'll show you why time is important while investing. So just remember the figures here, that by investing 24 lakhs, you're getting 5.9 crores, right? Now we'll change in the investment period. So since we'll keep the amount to be same, that is 5,000 rupees, and I think we all can skip 2 dinners in a month and invest 5,000 rupees. And here in the investment period, we'll put in 30 years, right? Because right now, if I'm in 20s, I'll say, okay, I need to enjoy my life. I'm not going to sacrifice those 2 dinners a month. And that is why I'll start investing at 30. What sense will it make? So let's put in the amount, the investment period to be 30 years. And we'll keep the expected annual returns to be 12%. Now let's click the calculate button and see the difference. So see the difference here. Just from 6 crores, your expected amount has reduced to 1.8 crores. That is, your amount has decreased thrice. Your amount has decreased from 6 crores to 1.8 crores. That's it. And your amount invested has decreased just by 6 lakhs. So that is a very huge difference which time makes. First you were going to earn 6 crores and now just 2 crores. I mean, I think everybody of all of us want that 6 crores and not just 1.8 crore. So that is why I say time is important while investing. Now let's take another example and see what results it gives us. Now, for example, somebody says, it's okay, I started investing late. So now since I'm 30, I'll start investing 10,000 because I earn that much now. And yes, I can invest 10,000 rupees per month. So, okay, we'll put in 10,000 and see the results. Now we put in the amount as 10,000 again for 30 years and again at 12%. And now we'll see the results. Just see. So even if you increase your investment from 5,000 to 10,000, you are still not reaching that still not reaching that goal of 6 crores. You are still getting just 3.5 crores, though in spite of your amount invested being increased. You have increased your invested amounts from 24 lakhs to 36 lakhs, but still your expected amount is just 3.5 crores and not 6 crore. So that is why, again, that was the comparison I made to show you how time works while investing. Now let's take another example. Okay, now let's suppose there is somebody who is around the age of 25, and he has a good job, he has a good salary. So now he can invest 36,000 per month easily, because he earns like around what, 1,50,000 to 2 lakhs. And as Deven sir explained us, that we need to keep aside 30% of our income for investment. So now we put in 36,000, and since he's of the age 25, so he can invest for 35 years, right? He can invest for 35 years. So we'll put in the investment period to be 35 years. Expected return, we'll keep the same at 12%. I'm not increasing that. And then we click the calculate button and see the results. So just see the results here. When the person invests for rupees 36,000 for 35 years at 12% interest, he gets 23.4 crores as the accumulated wealth. and he invested only 1.5 crores. So just by investing 1.5 crores in 35 years, he's getting a return of 23.5 crores, which I think you wouldn't be able to get if you had just saved the money and put your cash in your house, in your almiras. That wouldn't have made any sense. So that is why, again, I say investment is important. Now, let's compare these figures and understand an example again. Now, just remember the figures, please. Then only you will be able to compare. So we are getting 23.5 crores while investing 1.5 crore. Now, he says that, okay, I'm 25 right now. I want to enjoy my life. I want to party. I want to go out with my friends, and I don't want to start investing. When I'll be 30, I'll still have around 30 years for my retirement. So I can start saving from the age of 30. So, okay, let's take those figures and compare. Now let's keep the investment period to be 30. Expected return, we'll keep the same at 12%. Okay, now let's calculate and see the difference. Here. So just see the difference here. Your expected amount has reduced to half. It has reduced from 24 crores to just approximately 12-13 crores. It has reduced to half, and your amount invested has just reduced by 0.2 crores. So the amount invested has decreased so less, just a minor difference, and your expected amount shows a relatively good change. It just reduces to half. Again, just in the span of 5 years, just in a span of 5 years. And that is why I say time period matters while investing. I'm definitely sure everybody of us wants your 24 crores and not just 12 crores. So that is why each year matters while investing. That is why one should start investing from the very first day he or she starts earning. Now, what Aditya sir explained us was that market works in a very different way. There are sometimes inflation, there is sometimes deflation. There are a lot of things happening in the market. And if somebody diversifies their portfolio, if somebody understands the market, he or she can change that 12% of interest to 15%, to 14%, to 18%. They can definitely increase this 12% because now they understand the market. They know when to purchase the gold. They know when to invest in real estate. They know when to invest in equity. So they can understand the market. They can evaluate the market, and then they can change that 12% to 15%. Now, I'll show you how this 3% makes a huge difference while investing. So just see here, before we were investing 36,000 at 12% interest, we were just getting 12 crores. But now when we invested for 15%, we are getting 25.2 crore. Again, double the amount. So just by increasing the 3% of expected annual return, you are getting double the wealth. You are doubling your wealth. That is the point of time you are attaining your wealth maximization, because you are changing that 12% to 15% because of your knowledge about the market. And that is why rate of interest, investment period, all of these things matter while investing. So I just want all of you to go home today and check this website out, try different permutation and combinations, try putting in different investment amount, investment period, expected annual return, because for some it might work at 14%, for some it might work at 12%. So everybody has different goals in their life, and just decide your goals, just try out different amounts and set a goal for yourself and start investing. With that, I have covered all the things, and we all have covered all the things, but I would want you to remember one thing. Since we have understood how we can budget and manage our personal finances, and as Aditya sir has explained us what are the different avenues available to us while investing, and I've showed you why time matters, what are the expected annual return you should invest your amount is. So guys, just think about it, just try this website out and try to think how you can start investing from the very first day. Now we are open to question and answers. So if anybody wants to ask them, please go ahead. So we have one question here from Rahul, who is asking any tools to manage these all this. So Aditya or Deven, who would like to answer this question?
Sir, could you be more specific, like manage these as in? So basically, I'll answer to Ishan Jain. So where should I go to start investing? So sir, it depends on which instrument you want to choose. If you want to go for mutual fund, so you can go for direct or regular plans. If you want to invest in secondary equity market in the stock market, so for that you will have to open a demat account with a broker, and then from there on you can start investing.
We have one more question from Sahil Kataria.
Uh,
Where should one park emergency fund?
okay,
How
so
long
I'm
should one
answering this.
keep adding in the emergency fund? Yeah.
So the best way to park their emergency fund is liquid fund, because liquid fund are giving more return than a saving account balance. First thing, and second thing, uh, it's a safe because the entire money you are investing is going to a treasury bill T90 bills, which is managed, which are all government bills, of course. So it's simple. You can simply open a demat and you can park. The mutual fund have a liquid fund options. You can buy the liquid fund from there.
So, sir, the idea for to park money in emergency fund is that you do get lower return rate over there, but the thing is they are relatively safer. And to answer Rahul's question, how to keep an eye on all of the investment. So, if you are investing in stock markets, you always have a portfolio. And like if you are investing through ICICI Direct, you will have a portfolio. You will be able to track all the holdings. You will be able to track what your current profit or current loss is, and you can take a decision based on that. So you will also have to keep an eye on the stock markets if you're going into secondary equity. And to answer Ishan's, yes, I'm thinking to start in equity. How to open a demat account? So for that, you can contact us. You can contact after the webinar, and the basic thing is that you can just go to ICICI Direct website and you can open your demat account. You just have to produce the documents over there, like PAN card and identity proof, address proof or some. And for that, you can always contact us. Rahul, thank you guys. I've learned a lot. Thank you. So any more
Any more
questions?
questions?
Deven, there is a question from Sahil. It's a follow-on question. How long should one keep adding in the emergency fund?
Okay, so like I discussed the example of August. August, you must be thinking I already have 50,000 rupees, but the thing is, emergency you can't really predict it. So what I was talking about is discipline for next 40 years. So after 40 years, you were having a corpus of 1.8 CR. So emergency fund is you are allocating 10% for that. You can whenever you have a good accumulation amount, uh, till then you should add every month 10% of your income, because we can't really predict कि emergency कब आ सकती है, because we never predicted pandemic कब आ सकता है. We never predicted कि हमें 4 या 6 महीने salary नहीं मिलेगी. We never predicted कि businesses half हो जाएंगे. So that's the concept of emergency, that you don't know, that is unpredictable, and you're just allocating 10% of your income in that. So I don't think it's a big chunk. You should do it till the time you have that income filling the pot that is in your bank account. So I don't think a emergency fund कोई भी एक छोटा सा time horizon के लिए रखना चाहिए. Okay, so minimum less time to invest to get.
So the question is, how much is the minimum time to get best returns? So what is the minimum lock-in period that one should look at to get best returns?
So, sir, to answer that, we are talking about investments, and if we have seen anything in the past, uh, whenever people have invested for 5 years, 10 years, or more than that, they have got handsome returns. And there are people who have taken an exit from the market or their investment in 2 to 3 years just because they were getting a gain of 8 to 10% or 15%. But that was our concept, power of time. So power of time is like case mein there's a concept compounding, power of compounding. So if you want to be financially free, because we were talking about financial freedom, ki definition was after retirement you should be financially free, you should not be dependent on anyone. So we won't be really talking about less time to invest, because we are talking about financial freedom, and that cannot be attained in 1 year or 3 years or 5 years. So that's why we were discussing a corpus of 40 years.
Adding on this, some minimum time, if you are looking, you can directly go for bonds and FD, because if you are wanted to invest for a less time is less than 1 year, so there should be a sure return. You can't take the risk in the market. You should go for AAA rated bonds, which is okay, and it will give around 8.75% return.
Okay, so how to cover up if we haven't started investing till now in SIP, if someone want to start at age 30 or age 40 respectively? So the idea over here is, it's not like a late ho gaya, it's never too late to invest in the market. And uh, if you're planning to invest in the age of 30, so we were discussing 20 age pay, we were just investing 5,000 rupees or 10,000 rupees. And if you are in the late 30s or early 40s or late 40s, I'm sure you can increase the amount. But the thing is that time jo nikal chuka, you can't really grab that, because that was the most powerful factor over there. But that should not discourage you. You can always start planning your finances. You can always start working towards attaining financial freedom. So time nikal chuka hai, that should not discourage you.
I think Ishan has a question. He's raising his hand. So Ishan, if you could unmute yourself and ask if you don't want to type.
He typed 2 questions. I think they were covered. Yeah.
Okay.
Is it worth it to invest more at the age of 30 than reducing your emergency fund, or how to increase your investment amount from the plan? Is it worth it to invest more at the age of 30 than reducing your... So like Aditya discussed, that according to the age, you will have to define your investment strategy as well. You can't really go with the standard investment strategy के 25 की age किसी की है तो वो भी same चीज कर रहा है, और 50 साल की age है वो भी same चीज कर रहा है. So we always have the formula, like Aditya discussed, that 100 minus age, that should be the allocation when you're going for equity or debt. So is it worth it to invest more at the age of 30 than reducing your money, emergency fund, or how to increase your investment from the plan? So it always depends on your risk appetite as well. And फाइनेंशियल फ्रीडम भी सबके लिए फिक्स नहीं हो सकती है. किसी को चाहिए होगा कि मेरे को 1 साल के लिए 15 लाख रुपए चाहिए आफ्टर रिटायरमेंट, एंड किसी के लिए वो हो सकता है मेरे को सिर्फ 6 लाख रुपए चाहिए. So everyone has different requirement, everyone has different risk appetite. So accordingly, we will have to define our investment strategy. If we are not alive at the time of return, so where it will go? Sir, nominee के पास चला जाएगा, family के पास चला जाएगा. So idea ये नहीं है कि हमें financially freedom खुद के लिए चाहिए. Idea ये नहीं है कि हमें financial safety खुद के लिए चाहिए, because हम पे भी कुछ dependent होते हैं लोग. And अपने लिए financial freedom attain कर रहे हो या अपने लिए financial safety आप create कर रहे हो, तो उसके साथ दूसरों की फैमिली, मतलब दूसरों के जो डिपेंडेंट होते हैं, हमारे जो डिपेंडेंट होते हैं, उनको भी सिक्योर करना पड़ता है फाइनेंशियली. सो इफ वी आर नॉट अलाइव एट द टाइम ऑफ रिटर्न, सो वो बैंक नहीं खा जाएगा या ऑर्गेनाइजेशन नहीं खा जाएगी. देयर इज ऑलवेज अ क्लॉज कि आप नॉमिनी ऐड कर सकते हो, तो वो उनको मिल जाते हैं.
Do we have any more questions?
Okay, so there is a question. I think we've answered. Deven Sharma, we have answered, right?
Yeah, I just answered.
Great.
मतलब answer satisfactory नहीं लगा तो I can answer again.
So Chani, if you're not present when the returns comes or when something happens to us, if I am investing, then the nominee gets the amount, and we can choose who we want as the nominee. So we can choose anyone from our family to be the nominee, and that's how it is. Okay, great. Any other questions, guys, from anyone? Great. So it was a wonderful presentation. Thank you, Vanshika, Deven, and Aditya. It was truly amazing. Is there anything else that the three of you would like to add?
Yeah. So we are launching, we have already launched 4 clubs of Together Investing Club. And now we are launching again in Jaipur on 23rd of August. So if anybody of you is interested to learn about stock markets, want to learn about how market works and how you can invest your money, you can go to our website at togetherinvesting.com and leave your details. Our team will contact you. Or if anybody of you, you can contact directly to the people who have invited you for today's webinar. Thank you. That's all. Thank you for coming to the webinar. That's all. Thank you so much.
The
So
difference of 12 to 15% you can make because the science of investment, you should learn how to manage your funds, how to manage your personal finance. So it is good you if you wanted to jump from 12 to 18% or 12 to 15%, you should learn how to manage your own funds because it will help you in your own business also. Thank you.
So we'll be sharing all the resources, all the Excel tools and the website links with you after the webinar. We have your contact details because you registered on Zoom. So idea over here is not only to attain financial freedom, but to become financially literate as well. Because we have a long journey to go. We have like if we are in 20s, so we have 35 years. If we are in 40s, we have another 20 years. So financial literacy is going to serve you. And if you are asking someone, if you have given that responsibility to someone to manage your funds, so you should have a basic level of understanding if that guy is doing the right thing or not with your money, because finance is a very personal business and you need to have a basic understanding of how to manage your personal finances. So for that we have Together Investing Clubs, and we have had people from different backgrounds, and they have been able to understand the financial market in a better way. So for that, you can get in contact with us or the person who invited you, because this was an invite only presentation. Thank you.